Let's bring in our first guest for the hour. We've got Jill Carey, Bank of America Senior, or Jill Carey Hall, I should say, Bank of America Senior U.S. Equity Strategist. And Jill, from a markets perspective, when you look at the action today, where we are, we're kind of right back near the levels that we saw pre-Omicron variant right after Thanksgiving Day. How do you think things are looking right now or setting up for the year end?
Well, I think the Omicron variant has obviously been a key variable that contributed to the sell-off that we saw, and a lot of uncertainty remains around that. But our colleagues are so far thinking that, while much is yet to be known, it so far signs point to it may not change the course of the pandemic dramatically. But obviously there's a lot we still need to hear there. If COVID gradually improves rather than a major resurgence in 2022, we think that we would expect we could see a continued recovery in the U.S. economy, continued recovery in services spending. So our view going into 2022 is that while it may not be a great year for the large cap U.S. equity market, the S&P 500 index, where we're actually looking for flattish returns, this index is a lot more, overvalued. You have the Fed tightening next year into an overvalued market. We do see opportunities within pockets of the market that are more exposed to the services recovery, to the domestic U.S. economy, like smaller stocks over larger stocks.
Yeah, 4,600 year-end target for next year, basically flat there if you think about where we are now. When you dig into some of those opportunities, though, as you're describing them, I mean, how does maybe the Fed's outlook for next year maybe help or strengthen some of that thesis around where you see the opportunity when it comes to maybe a shifting take on inflation?
Mm-hmm. Yes, so we do think that the Fed is slated to begin hiking in June and potentially risks it could be even earlier. And when you think about the fact that we'll have cash yields rising, that obviously does make the dividend yields on the market less competitive. So we do expect inflation to remain elevated as well. So there we see opportunity within looking at stocks and sectors that offer inflation protected yields. So areas like energy that offer healthy dividend yields, free cash flow yields, but are areas that don't necessarily get hurt by higher inflation. And then with the Fed hiking, I mean, I think you have typically seen the market up during tightening cycles. But as I mentioned earlier, the S&P 500 is an index that's trading at rather expensive valuations relative to its own history. Multiples on the index, PE multiples are the highest that we've seen since the tech bubble. So obviously there are some parallels with 99 and 2000, obviously a number of differences as well. But the index today, we've seen a lot more euphoric equity sentiment. So potentially reasons to be cautious in that regard. We do like smaller stocks. They've typically done well leading into tightening cycles. Historically, the performance has been a little bit more mixed to negative relative to large caps once tightening cycles have begun. But again, one difference today is that this is the only tightening cycle aside from 1999 where small caps weren't actually expensive versus large caps on valuation going into it.
I mean, so talk to me through that case. I mean, it sounds like this is more of a short-term play if you're talking about small caps, given that we're anticipating the tightening cycle to accelerate even further. If you say historically they have underperformed during those cycles, have a little more mixed reviews, what's a good time? Is now the time to get in potentially in anticipation of further tightening from the Fed over the next several months?
I think, obviously the risks could grow as you move out later into the year for small caps. If tightening does begin in June, you have typically seen the index, the small cap index do well relative to large caps, both when tapering commenced and then in the months leading into that first rate hike. But again, I think a difference versus, history is that, typically small caps were more expensive leading into those tightening cycles. So perhaps one mitigating factor, even as rate hikes begin today. I also think there's, a number of other factors that can drive small cap performance this year. Looking beyond, the risks from tightening, I think you have the CapEx environment accelerating right now. So if companies are spending, investing on CapEx, you have the infrastructure bill, you have reshoring of U.S. manufacturing. We found that CapEx cycles tend to be better for sales of smaller companies within the U.S. than larger companies. So this could be a tailwind for smaller caps. And then really when you think about where the index is trading right now, I mean, the small cap Russell 2000 index is trading in line with its long-term average forward PE multiple versus when you look at large caps, they're trading about 40% above history. So, a lot less valuation risk within the small cap size segment right now. And, for longer term investors, valuations don't necessarily tend to be super predictive over the short term, but over the long term, we're actually, our frameworks today are spitting out that based on today's valuations, you could actually see slightly negative price returns on an annualized basis over the next decade for the S&P 500, whereas the same framework for the Russell 2000 would suggest you could actually see a very good decade for small caps with, higher single-digit annualized price returns.
Getting a strong sense you like the small caps here. And when we look at maybe the alternative here, right, when we're talking about technology, you're going back to kind of the 1999 tech bubble situation, looking at statistics there. It's been a tough year for tech IPOs and really pointing to big winners there. You can point to some big losers, including the likes of Robinhood. I mean, what does that maybe also tell you about where the market is in terms of picking favorites right now, and why that is also, I suppose, another reason to be juiced on small caps?
Mm-hmm. Yeah, the IPO backdrop, we've definitely seen an acceleration in deals there to the highest levels that we've seen since the tech bubble. But, I think there are a number of mitigating factors that reasons why today looks a little bit different from 1999, 2000. When you look at the total value of deals, when you measure that as a percentage of market cap, we're still well below 1990s levels. And, surprisingly, even though you've seen all of this new issuance added into the market's still much less awash with public companies than it was back then. So back in the tech bubble period, you had over 6,000 public companies. Today, you have half of that, even though it's recently ticked up a little bit. And I think though that there are risks in certain pockets of the market and even within small caps. So health. You mentioned tech has been one area dominating IPOs. And it did obviously during the tech bubble, but the sector that's really dominating IPOs today is healthcare. So biotech and a number of life sciences companies, where there you are seeing a lot of newer, earlier stage companies come to market, companies that have no earnings, and so we do see more risk in healthcare within small caps as an area that some of the recent dynamics have caused more reason for caution.
Some good takeaways there. Jill Carey Hall, Bank of America Senior U.S. Equity Strategist. Good to talk to you today. Appreciate you stopping by.